Welcome back to the Deep Dive. Today we're getting into the Q3 2025 earnings call for Cricut Inc. That's ticker CRCT. And on the surface, this was a really strong quarter operationally. I mean, they beat expectations pretty clearly on profitability metrics, revenue, EPS, margins. All looked good.
Yeah, they did. They're definitely executing on that shift towards a higher margin, subscription-focused model.
But the market reaction was, well, skeptical is putting it mildly. It felt like all that internal success was just ignored because everyone was focused on this one big external risk.
It really is a classic case, isn't it? You've got this great internal execution, hitting impressive numbers, but it's just completely overshadowed by these sort of macro fears from outside.
Exactly. Management doubled operating income, doubled EPS year over year. Pretty impressive stuff.
Fantastic numbers. But yeah, investors seem to barely blink because the whole conversation immediately pivoted to this looming tariff problem.
So that's our mission today, right? To unpack these two kind of contradictory stories.
Precisely. First, how did Cricut actually pull off this big jump in profit? How are they leveraging that platform strength?
And second, isolate and really look at that one big variable, the Section 301 tariff risk that just seemed to dominate how investors reacted.
Let's do it.
And so let's start with that operational beat, because the margin story, you have to admit, it's genuinely impressive.
It really is.
Total revenue came in at $170.4 million. Now, that's only up 2% year over year, pretty modest growth.
Right, a slight beat on consensus there.
But this quarter wasn't really about, massive top-line growth. It was all about converting that revenue into profit.
Exactly. Profitability was the headline.
GAAP EPS hit $0.10. That's a full 100% jump compared to last year.
A double.
And it blew past the consensus estimate, which was only $0.05.
Yeah, doubled the street's expectation. And net income followed suit, right? Up around 79% to $20.5 million.
So this isn't just like, oh, they slightly outperformed. This feels more like a structural shift in how they make money.
I think that's right. It's proof that their strategy that pivot towards profitability, it's actually working. And you can see how it's working when you look at the margins.
Right, the leverage.
Yeah, the leverage.
Yeah.
Total gross margin jumped sharply to 55.2%.
Which was up from what, about 46% last year?
36.1% last year. So that's a huge expansion. And that efficiency flows right down. Operating income more than doubled up 114% year over year to $22.7 million.
And you mentioned GAAP EPS earlier. Just for clarity, that's generally accepted accounting principles, the sort of standard accounting rules?
Correct. So when a company doubles its GAAP EPS, it means even under those strict rules, they've fundamentally become more profitable per share. That's what happened here.
Okay, but what's really interesting, I think, is when you dig into the segments, there's a big difference in performance there.
Oh, absolutely. A huge divergence. The platform business is clearly the engine driving all that margin growth and profit.
So what are the numbers there?
Platform revenue was up 7% year over year, hit $82.8 million. They crossed a milestone, too, just over 3.0 million paid subscribers.
Okay, 3 million subs, up 6%. And ARPU, average revenue per user.
Also strong. ARPU is up 4%, hitting $54.96. So they're getting more subscribers and getting more revenue from each one.
And the margin on that platform revenue, that's the number that really jumps out.
It's staggering, isn't it? Platform gross margin was 89.2%.
89.2%.
Yeah. It shows incredible leverage. Almost every extra dollar from a new subscriber or higher ARPU just drops straight to the bottom line. It really confirms how valuable that subscription model is.
But, and there's always a but, that nearly 90% margin on the platform side is kind of having to carry the weight for the product side right now.
That's the tension, exactly. Products revenue overall was actually down 3% year over year.
So let's break that down. How much risk is there in relying so heavily on that one, albeit very high margin segment, if the platform stalls?
That's definitely the key long-term question.
Yeah.
Right now, the platform is basically masking some weakness in their physical goods sales.
It wasn't all bad on the product side, though.
No, not entirely. Connected machine sales, the actual cutting machines, they were up 12%. That was helped by new launches and higher average selling prices.
Okay, so people are still buying the core machines. Where's the drag coming from then?
It's the consumables. Accessories and materials revenue dropped significantly, down 17% year over year.
Ouch. That's a big hit. Did management talk about why?
They did. They acknowledged they're losing share there. They said it was mostly going to, white label brands, private labels, and competitors popping up on Amazon and other online marketplaces.
So cheaper alternatives are eating into their materials business.
Seems like it.
How are they planning to fight back on that? Because, if users aren't buying Cricut materials, does that eventually lead to them using the platform less? Could it cause churn down the line?
That's the risk, absolutely. Their plan seems to have two main parts: promotions and price competition.
Okay.
They're pushing their Cricut value line harder, trying to offer materials at those more aggressive price points to win back some of that share.
Right. Compete directly on price.
Exactly. But the challenge there is balancing, getting the volume back without completely killing your product margins,
Right.
which are already much tighter, around 23% for products overall.
Yeah, a tricky balance. Okay. Shifting gears slightly to strategy. Management seems to be investing pretty heavily to keep users engaged and attract new ones.
Definitely. They launched 2 new cutting machines, as we mentioned, and a whole range of new materials, too. Things like printable temporary tattoos, magnet sheets, even fancy new iron-on types like flocked and 3D.
Trying to keep things fresh, give people new projects to try.
Right. And their marketing efforts are ramping up, too. They said overall marketing engagement was up more than 20% year over year.
How are they achieving that?
They mentioned strategically broadening their target audience. They're going after users maybe with a bit more disposable income, a bit more free time, trying to overcome those initial purchase hurdles.
And how do they know it's working?
They tracked brand searches. They said increased searches for the Cricut brand is a key leading indicator for them, suggesting future demand is building.
Makes sense. And they also talked a lot about simplification, didn't they? Improving the user experience.
Yeah, a big push there. The goal is to dramatically simplify the process for the most popular projects, like making an iron-on t-shirt or a vinyl decal or a folded card by the end of 2025.
Trying to reduce that frustration factor, especially for new users.
Exactly. Automating tricky steps like image sizing, making it easier to get a successful result the first time.
Which ties into their AI efforts, I guess.
It does, yeah. This is pretty crucial, actually, for keeping subscribers happy and justifying the subscription cost. They moved their Create AI feature out of beta and into full production for Cricut Access subscribers.
What's special about their AI compared to, say, just using a generic AI image generator?
The key difference, and it's a big one for crafting, is that Cricut's AI generates vector-based images.
Okay, vendor versus dot raster.
Right. Most standard images, like photos or images from generic AI tools, are bitmapped or raster images. They're made of pixels. When you try to cut those, especially complex ones, the software often struggles to find clean cut lines.
Ah, so that leads to failed projects and frustration.
Exactly. Vector images, on the other hand, are defined by mathematical paths. They scale perfectly and provide clean, precise lines for the cutting machine to follow.
So by generating cut-ready vector images directly, they significantly increase the chance a user, especially a beginner, will succeed.
Precisely. That successful first experience makes the subscription feel much more valuable, reducing churn. They're also using AI behind the scenes, by the way, improving their search algorithms to show relevant content and even speeding up their own software development.
Okay, that's a clear differentiator. Now, before we get into the tariff storm cloud, let's just quickly touch on the company's financial foundation. How stable are they?
Very stable. Rock solid balance sheet, actually. They got $207 million in cash and cash equivalents.
And debt.
0 debt.
Then, wow, okay. That definitely provides some cushion.
It provides significant breathing room and the firepower to manage these kinds of external shocks. They're also still returning capital to shareholders.
Right, buybacks and dividends.
Yep. Repurchased about $2.3 million worth of stock in Q3. That was about 441,000 shares. And they authorized their next semi-annual dividend of 0.10 cents per share, payable in January 2026.
Okay, so strong foundation, shareholder returns. But now we have to talk about the elephant in the room, the tariffs. This is the reason the stock reacted negatively despite that operational beat, right?
Absolutely. This was the dominant theme.
So what exactly is the exposure here?
Management was quite direct about it. They confirmed roughly 75% of their cost of goods sold. Their COGS is exposed to these Section 301 tariffs.
75%. And just to clarify for everyone, COGS, cost of goods sold, that's basically the direct factory cost for the machines and materials they sell.
That's right. The cost of the physical stuff they import and sell. And these Section 301 tariffs are those broad U.S. tariffs, mostly targeting goods from certain Asian countries, often related to intellectual property concerns.
Which countries are we talking about for Cricut?
Their exposure is primarily from production in 4 key regions: Malaysia, South Korea, Thailand, and still some finished goods coming out of China.
Okay, 75% exposure. And what kind of rate are we talking about? How much will this actually cost them?
This is the worrying part. Management said they are currently modeling about a 20% average tariff rate flowing through their financials on that exposed portion.
20% on 3/4 of their KGS. That sounds like it could be, well, potentially devastating to those margins they just work so hard to build up.
It's a massive potential hit. And crucially, they warned this impact really starts hitting in Q4, but it's expected to accelerate significantly into 2026.
Accelerate, why?
Inventory lag. Basically, they've already paid the tariffs on goods they've imported and are holding in inventory. But those higher costs only hit the income statement, affect the margins, when that specific inventory is actually sold. So the full impact builds over time as they sell through the higher cost goods.
Got it. So the pain increases next year. What are they doing to fight back? Can they mitigate this?
They're trying. They talked about accelerating their supply chain diversification, basically, moving production out of those tariff-exposed countries as fast as possible.
Okay, that makes sense. What else?
They're also driving internal cost reductions, trying to find savings elsewhere in the business. And they mentioned managing their price and promotional mix, maybe trying to pass some of it on or absorb it strategically.
But they were pretty clear that it's going to hurt margins next year, right?
They were explicit, yes. They said investors should expect pressure on gross margins in 2026, despite all these mitigation efforts.
So it really is this perfect storm, isn't it? The company is executing really well on the stuff they can control, the platform, the subscriptions, the high margins.
Right, that internal engine is running great.
But it's running smack into this huge external geopolitical headwind that they can't directly control.
That sums it up perfectly.
All right. We've laid out the numbers, the strategy, the internal success, and that really significant external risk. Now, let's put on our slightly more speculative hats.
Okay.
It's time for our This Is Not Financial Advice segment. We take the data, the volatility, the knowns and unknowns, and we construct an outrageous, maybe, but still plausible trade idea based on the situation.
Sounds good. And given this setup, a healthy company hitting a predictable, politically driven obstacle, the volatility here does potentially create an interesting, targeted kind of opportunity.
Okay, what's the pitch?
I call it a tariff catalyst call spread.
A tariff catalyst call spread. All right, break that down for us. What's the core idea?
The thesis is basically this. Right now, the market seems to be pricing Cricut almost entirely based on that known sort of guaranteed pain from the tariff flow through in 2026.
So pricing in the worst case tariff scenario.
Pretty much.
Yeah.
And in doing so, it feels like it's largely ignoring the underlying strength, that robust platform growth, the incredible 89% gross margin on subscriptions, and importantly, that $207 million cash cushion with no debt, which provides a real fundamental floor.
Okay, so the market is focused on the short-term pain, ignoring the long-term engine and the safety net.
That's the thesis.
Yeah.
So the strategy isn't about trying to dodge the hit in 2026 that seems likely to happen to some degree. It's about betting on what comes after.
How do you structure that bet?
The idea would be to buy long-dated call options, maybe 12 to 18 months out.
Long-dated calls, why?
Because you're specifically betting on one of two things happening, probably in late 2026 or beyond. Either one, there's some kind of political resolution, maybe a change in trade policy, tariffs get reduced or removed. Or two, the company's own mitigation efforts, especially that supply chain diversification, are successful and happen faster than expected.
So you're betting that the 20% tariff impact they're modeling either doesn't fully materialize long-term or it gets resolved somehow.
Exactly. If they manage to shift production significantly, or if the political winds change, that 20% modeled hit might be avoided or lessened considerably down the road.
And the call options give you leverage to that potential upside.
Right. This strategy tries to minimize your capital exposure during the period of maximum uncertainty and margin pressure next year. You're not buying the stock directly and riding out the volatility. You're making a defined risk bet using options.
What's the potential outcome?
Well, if management pulls off the diversification faster than expected, or if the tariff situation improves politically, the stock could have significant upside potential. Because then that powerful subscription engine with its compounding economics really gets to shine again.
And the downside?
If the tariffs stick around exactly as feared and mitigation isn't enough, well, you likely lose the premium you paid for the call options. That's your maximum loss on the trade itself. But the underlying business with its strong balance sheet, probably doesn't collapse entirely, which limits the catastrophic risk you might see in a heavily indebted company facing the same headwind.
So it's basically a leveraged bet on either political normalization or successful supply chain reengineering, timed for after the initial shockwave hits.
That's the idea, a pure play on the resolution of the tariff issue, not on avoiding the initial impact.
Fascinating. A very specific catalyst-driven idea. Okay, let's quickly recap our deep dive on Cricut's Q3. Operationally, the company is executing incredibly well on its high-margin subscription strategy. They delivered huge margin expansion, doubled their EPS.
Driven by getting over 3 million paid subscribers and leveraging that phenomenal 89% platform gross margin, the internal engine is humming.
However, that Section 301 tariff situation, specifically the potential for a 20% average rate hitting 75% of their COGS.
Yeah, that's just an unavoidable headwind for 2026, and it completely overshadowed all the good news in the immediate market reaction.
Okay, so to leave you, our listeners, with a final thought to chew on.
Given that these tariffs are a known risk, management is actively working to mitigate it, and they do have a very strong balance sheet to weather the storm. Which metric should really be driving the valuation right now?
Is it the sustainable, high-growth, 89% margin platform business?
Or is it the temporary, hopefully, but definitely scary, 75% COGS exposure to those tariffs? How much of the current price is pricing in the risk versus the actual ultimate impact?
That's the key question investors need to grapple with for Cricut over the next year or so. And as always, please remember, everything we discussed here on the Deep Dive is purely for informational and entertainment purposes. It is absolutely not investment advice.
Please continue to do your own research before making any investment decisions.
Thanks for tuning in, and we'll catch you on the next Deep Dive.